All right. Well, thanks for having us, Ron. We're happy to be here. And I'm Leslie Jo Osborne, and this is John Bohannon. So we both work in the R&D tax credit department. And I've been in the industry for about 7 years, working in specialty tax. And John, how long have you been doing this?
I started in May of 2017, so closing in on about a decade.
Yeah. Okay. And I work in business development, and then John runs the actual studies for us, and he is a tax attorney by background. So yeah, we're happy to be here and share the gospel of R&D. So with that, John, you want to go to the next slide? Okay, so agenda for today, well, we already gave introductions here, and then we're going to give an overview of the R&D tax credit, and then there will be time for Q&A at the end if we happen to have any guests who come in. So we'll be watching the chat there. All right, so R&D tax credit is a specialized part of the tax, and so when we look for qualification, we're actually looking within the business at the activities being performed by the employees involved in the business. And so the IRS calls this code a 4-part test that has to be passed as far as what kind of activities qualify. So those 4 parts are: part 1 is that there is a new or improved process, product, technique, invention, formula, or software. And it does not have to be new to the world, just new to the business. So that is part 1. Part 2 is that there is an uncertainty involved in this product, process, etc. That is technological in nature. So it's focused on the hard sciences. The uncertainty is focused on the hard sciences. And then the other part is that there's a process of experimentation being used to resolve said uncertainties. So again, when we scope a business for qualification for the R&D tax credit, we're actually looking at who is doing what within the company, and do their activities check all 4 parts of the 4-part test. And that is where we start in looking for qualification. So that's the kind of high-level introduction to R&D, and then I will let John expound further on what this actually looks like to get to obtaining the R&D tax credit.
Perfect, thanks, Leslie Jo. And so, I didn't get to be an attorney without learning how to pontificate. So I'll certainly elaborate on these a little bit. Hopefully, add a little bit of clarity without getting too far off in the weeds here. But I wanted to elaborate on each of these 4 elements to give an idea both of how these requirements can require a fair bit of substantiation and documentation required, and that requirement can narrow to some degree the kind of breadth of companies that are realistically eligible. But at the same time, I also want to highlight that these definitions are also necessarily really broad, and provided that information is there, it really can apply to a wide number of industries and number of companies, particularly in light of the relatively recent changes that got implemented around 2016 and beyond. First, though, is starting with that first element that I really like to highlight to people looking for prospects or to prospective clients themselves, is that this list is just about everything under the sun that you can think of, right? And really, even of these 6, umbrella terms, I would even go so far as to say is like the first 2 almost include everything, right? Or the product and process and software. If you're working on any sort of new or improved one of those things, then it can potentially qualify. That said, I do want to elaborate that when we're talking about like what is new or what is improved, those elements need to be confined to essentially performance or sort of quantifiable and elements of that product or process. So we're looking at a new or improved function, new or improved performance, new or improved reliability, or new or improved quality. And because again, it applies to improvements, this encompasses, projects that or types of trades that involve kind of like a continual development and improvement process. I think the most obvious example here is software development, where many technology companies will be working on something like a software platform that year over year, that's what they're doing, right? They're improving ways to make it faster, have more security around payment systems and things like that. And so that year over year work will continue to qualify and therefore make those companies oftentimes eligible to continue to claim this credit year in and year out. As Leslie Jo mentioned earlier, this is something that is really only required now to be new in the hands of the taxpayer, and similarly, those improvements need only really be evolutionary in nature, not revolutionary. That actually was a change from going into the 2016 sort of modern update to the tax code, is that you no longer have to show a much more enormous burden of having to prove that you're kind of advancing the state of the art of the industry with your new or improved sort of projects. Instead, you need only really show that this is a new challenge for you. The technical challenges that you're encountering are new to you, or the improvements that you're making are new to you. And again, to distinguish that, right, that doesn't include things like you're doing new or improved changes that affect style or taste or cosmetic or seasonal design factors, things like that. Secondly, this technical uncertainty element, I think this is the one that can, the code's terms of art can be a little bit confusing. And so I try to give a more layperson version of that, which is just technical challenges, right? In your project, in a client's project, if they are encountering technical problems, technical challenges that they have to resolve using engineers, using designers, using developers, using iterative testing. It's those kinds of challenges that we want to talk to them about, that we want to hear about, that we want to identify and quantify. And the code gives you these kind of three different columns or three different categories of what kinds of uncertainties can exist. The first that they talk about is the capability. So, if you're having I like to tell clients, if you're developing like the hoverboard from Back to the Future and doing something, completely out there that is pushing the state of the art of the industry. Nobody's ever done this before. You had no idea when you started the project whether you could really succeed. Well, sure, that's going to be a sufficient technical challenge that would definitely be eligible. But it can go much, there's a much lower bar that is still eligible here. If the challenges as to what is the best method for resolving the challenges you encounter, that typically, I think, applies more to processes in particular. What is the best process? What is the best method of that process for implementation? That will certainly qualify. And then finally, the design part is really what is expanding this to so many companies these days, right? The example I like to use a lot here is I'm thinking of like an engineering firm or say something like an architect, things like that, who when they do projects kind of day in and day out, they're sort of experts in their field. And I would oftentimes be interviewing them. And if it's their first time kind of being exposed to the credit, they oftentimes, not kind of knowing that this distinction, will think just that capability part. And they'll say, I've worked on designing buildings my whole life. I knew at the beginning of this project that I could definitely succeed, right? Or I knew I could definitely design the product that I was seeking to. And what I like to remind them is that that's fine. But if you know that you can succeed, but you still have to engage in like a very serious, systematic and iterative process of investigating how to appropriately design that thing, or how to appropriately resolve the technical challenges that you encounter, then that is sufficient alone in terms of the technical challenge kind of element. And so there's tons of companies that are going to meet this burden, even though to them they may think that the work is of a more ordinary kind of challenge, but that's because they're experts in the field. This process of experimentation is really what I want to spend the most time elaborating on here in terms of qualifying activities. I think it's the one that sounds the most like a mouthful to begin with, and deserves some clarification. The simplest way I like to break this down is just referring people back to their 6th, 7th grade science classes where you first learned about the scientific method, right? You're encountering something, you're making having an observation, making a hypothesis about that observation. You're then running an experiment to check and see if the experimental data lines up with that. And if not, then you're going back and reforming your hypothesis and running still more experiments until you've confirmed that the things that your model is fitting. And it's a good analogy for what we're seeing here, right? A process of experimentation, the code says, is any sort of method of investigation in which you're identifying one or more, doesn't have to be more, alternatives that you've kind of identified as being a possible method or a possible design choice that may ultimately resolve that the technical challenge that we were talking about in the last element. You've identified those potential design alternatives, and then you're conducting a process to then evaluate those alternatives to see which ones do in fact resolve the challenge, or if multiple ones do, identifying which one most effectively or most appropriately resolves the technical challenges that you have identified. And so, yes, this can be something that's fairly highly sophisticated. The code makes mentions of things like modeling or simulation techniques. So if you're doing a lot of 3D CAD designing, things like that, or sort of other methods of like computational fluid dynamic analysis, right? I don't know, the kinds of things that people are already probably going to have a degree of predisposition to thinking is R&D in the first place. Yeah, that stuff absolutely qualifies. But moreover, and much more commonly, is just systematic trial and error, right? You make your design, you run a test against it, you see that there are elements of it that works, there are elements that don't work, so you go back and you refine that and you run your trial again. I will say that the code does want to make a distinction between what it calls systematic versus simple trial and error. It doesn't provide a lot of great distinction on what that is, unfortunately, but I can tell you through practice and through experience that really what that mainly concerns is around this kind of first sub-element I mentioned here about identifying one or more alternatives. It's about showing that the process that you're implementing is capable of doing those things. You didn't just kind of have a challenge in a slapdash kind of way, go and identify off the shelf solutions, identifying one that you essentially kind of maybe knew or largely expected was going to resolve the challenge such that there really wasn't much of an investigative effort. In those cases, it's more likely to call it a simple sort of trial and error versus one that's more systematic and iterative. Finally, the fourth point, I just want to clarify that the code describes this as saying that it's the process of experimentation that you're using is what needs to rely on principles of hard science. It gives the four examples of biological science, physics, engineering, or computer science. I say this because I think one of the most common ways this can trip up potential prospective clients is really with like the computer science element. Sometimes people might think that just through the utilization of like computer equipment or computer processes themselves, like implementing new processes that is taking something from pen and paper kind of old record keeping to a digital record keeping or something might be sufficient to say that it's rooted in hard science. And that's where people can get tripped up, because it's in that case you might be utilizing some kind of trial and error sort of methodology, but it's really just evaluating what's out there and putting something into place, as opposed to say like trying to actually make a new piece of software, right? Coding software yourself, in which you're then using kind of fundamental principles about software development, right? Approaching it with, say, an agile development process or a waterfall software development approach. In those cases, you can more kind of fundamentally attribute the way that you're doing the process in order to resolve the challenge to something that's relying on these hard sciences. Similarly, you might, technically involve something that you could describe as an engineering challenge, figuring out how you want to, brace something in order to resist forces that are going to act on the product you're developing. But if that's, again, something that you aren't then using a process that's rooted in engineering on how to actually test and evaluate those alternatives, that's more likely not to qualify or to be deemed, as I mentioned, simple trial. Lastly, there's a longer list of this, and this is the kind of stuff that it can go a little bit beyond the scope of what I think we want to cover here today in terms of identifying at a high level, potentially eligible clients. But there are a few that I think are worth mentioning that you can help to kind of quickly vet clients, out of the system. The first is foreign research, right? As Leslie Joe mentioned at the beginning of the presentation, the credit itself is supposed to be an incentive that's designed to be retaining high level and high technical jobs here in the U.S. So therefore, if those activities lie outside the U.S., that's not going to qualify. Only caveat I want to point out here is that it's about the work itself, not about, say, where the product goes, or maybe even where the project is located. And that's the one I most encounter is sometimes in the cases of like an engineering type job or something like that, where maybe the actual project site is located overseas, but then the engineering team that's working on that project is domestically based. Those expenses that come from the domestic team, they actually would qualify. Whereas if there's people there sort of, at the foreign site that are working on it, those won't. Finally, funded research is one I just want to point out that this can turn into a bit of a larger analysis, definitely the sort for folks like us, but it's still something to be aware of in terms of when you're vetting clients, distinguishing whether their projects are coming from like an internal development versus ones that are being contracted to do. The really quick explanation here is that in general, if say I hire somebody to create a software platform for me or something like that, right? In those cases, depending on how the contract is designed, but it's very frequent. If I'm hiring you to do something on my behalf, then the person that's doing that hiring oftentimes gets to claim the credit because they're the ones that are, again, they're bearing the expense, they're bearing the potential risk of doing that R&D in the first place, which is what we want to incentivize. And therefore, that person gets to claim the credit for those activities, as opposed to the person who's actually doing it, who may be doing it as a work for hire, and maybe doing so in such a way that they're not really bearing that risk. Now, if I pay you an hourly rate to kind of keep working on something for me, and I'm going to pay you regardless of whether you kind of succeed in your research efforts. Well, in that case, they're not really bearing that risk. I am, and so I should get the credit, not the other one. So something to point out, the real takeaway there is that you should be highlighting companies that are doing internal research and development, potentially research and development efforts, because they do not have to go through this analysis and are much more likely to qualify. So having gotten all that out of the way, if we at this point assume that a given taxpayer's project and the activities associated with that project qualify and they meet the 4-part test, they don't fall into any of the exclusions like we've mentioned, we then kind of determine, okay, well, how do we generate a credit based off of those activities? High level summary here is that there are 2 methods that are available for us to perform kind of the actual calculation, but they work in the same type of principle. They operate by having identified these activities and projects. We then go and take stock of the qualifying expenses that are associated with those activities. And then you're comparing it essentially to the same kinds of expenses in prior years, and you're getting a percentage of that increase, or in truth, it can be maintaining kind of expenses year over year, but you're getting a percentage of those qualifying expenses as a dollar for dollar reduction in your tax liability. That is, so all that's to say, the actual reduction is generally in a taxpayer's income tax. However, think in the case of like a small startup company, oftentimes for a startup that's developing a new product to take to market, they're often not making income from which they're deriving an income tax credit in the first place. And so to help incentivize those companies, kind of recent changes basically made it so that if you're a qualifying small startup, so you're making, say, an average of like under 5 million in gross receipts, and you've been around for only like about 5 years, then those companies get to actually apply the credit against their payroll taxes rather than their income tax credits, which can obviously be very beneficial because payroll taxes, they come to whether you're making income or not. And so that's the tax liability that they're actually going to be encountering at the time that they'll want to offset. So we've talked about, okay, what we're taking expenses, we're comparing those to expenses, the same kinds of expenses in prior years. Well, what expenses are those? There's 4 major categories. By far the largest contributor, and the one that you expect to encounter in essentially every industry and every project that you're working on is wages, right? If I'm hiring, engineers and software developers and that kind of thing, I'm paying them to work on these projects. Then we get to take a ratio of the salary that we pay them based on how much time that they're spending working on qualifying activities, as opposed to more mundane matters, administrative duties, training, etc. We get to include those wage expenses. I'd say probably the least common, but can, for the right industry, be hugely impactful is supply expenses. So if your research and development activities, require you to consume supply expenses in the conduct of those activities, then those can qualify. And classic examples would be product manufacturer types who have a lot of prototyping and sort of iterative prototyping expenses. We'll actually talk about some case studies here at the end, in which I mention an example of this. But those kinds of expenses can be included, and so where it's appropriate, these can be a huge category, often overlooked too. The third primary category is contractor expenses. This is essential. Oftentimes applies to any one of these categories here that we're talking about. But if you're instead paying a third party to do those on your behalf rather than you doing it in-house, well, you get to include those expenses as well. Only caveat there is that you basically get a bit of a penalty of sorts to that inclusion. You only get to take 65% of the total contractor expenses that you've identified. And then finally, this shows the age of the credit. This credit was originally in the 80s when we had great big supercomputers that we leased time on amongst a number of users. So this one is actually called the rental and lease cost of computers. But in the modern era, it's been utilized for quite a while now, and has not been challenged at all, to my knowledge, has been the use of cloud computing expenses. The only distinguishing factor here is that we're specifically talking about if you're incurring cloud computing expenses for the purposes of doing, R&D that lines up to that 4-part test I mentioned, those qualify. You distinguish that between, from those same kinds of expenses, but they're incurred for the purpose of, then actually running your now newly made software platform that you have resolved the technical challenges on already. If you then pay, for cloud, for Amazon Web Services, cloud computing, stuff like that, and you're paying for it to just run your servers now, we don't get to include those. But if you have, say, a development environment online that utilizes them, that would. So yet again, another often overlooked category that can have a really big impact. With those in mind, this kind of leads to what are the most frequently qualifying industries, and this list is far from exhaustive, but it definitely highlights the biggest kind of year over year qualifying industries. And I listed the top two here first, which are manufacturing and software development. I would honestly reverse those in terms of not just how often they qualify, but more like the relative ease in substantiating those claims. Software development is the industry in which the software development activities themselves are almost intrinsically meet that four-part test. You're sort of always coming up with software that is new in some way or improved in some way. You're almost it's necessarily an operation in resolving design challenges that are almost necessarily rooted in principles of computer science and that sort of thing. Moreover, in technology and software development industries, you oftentimes have pretty potentially a large number of employees, and even if it's a relatively small team, they're oftentimes highly compensated. And because it's based on the salaries you're paying those folks, the wage expenses are oftentimes really high. With manufacturing, it actually does tend to be a lower ratio of their overall spend, but their spend is oftentimes very high. And then they oftentimes employ large numbers of employees who, many of which will be highly dedicated, right? If it's a kind of specific engineers or product developers, things like that. But then they might have common kind of daily on the line fabricators and things like that who also may put a relatively small ratio of their time on newer improved product development, but there might be 100 of them at 10%, right? That's sort of the idea. Similarly, engineering firms are oftentimes qualified. I'll say the caveat there is with like things like architecture firms and engineering firms is there oftentimes is a lot of that quagmire I mentioned about the funded research. More often than these other categories, engineering firms oftentimes, their work is done under contract. They're done under sophisticated contracts that are necessarily, being initiated by a third party, and then you have to parse a lot of language to figure out, whether they are in fact eligible or not. So I would at least urge some caution. These last two are ones I would say are commonly qualified, but they're, again, relatively overlooked. Food and beverage is especially, I think, an often overlooked one. I know from experience that these clients I've encountered have seen the excluded activity thing that I mentioned around like taste and seasonal factors and things like that. I think that applies to them. And it's actually worth noting that the taste they're talking about is something like you're designing new clothes that you want to appeal to people's current tastes in terms of the aesthetics. But that's distinct from something like Frito-Lay wanting to make a new chip that tastes like barbecue or some exotic flavor, and then having to do the R&D to figure out how do we make the seasoning that coats that chip to actually produce that flavor or that design profile. In as much as their actual technical challenges like that, they are still eligible, and so that is where you see this often get overlooked, and therefore can be very lucrative. And on top of that, that's a kind of industry that can incur sort of at least all the three primary categories of expenses, right? So they can also have supply expenses. Similarly, ag tech is one that I would say is fairly often overlooked. There was even recent case law that came out recently that kind of further confirmed and endorsed that courts see these kinds of activities as being qualifiable. So definitely ones to point out. Beyond that, there's also lots of industries that you're going to find that, your predisposition is going to be that they're not qualified, and you'd be correct, right, on a day-to-day basis. Like my experience, I've had actually a number of like banks, mortgage companies, that, their day-to-day activity doesn't qualify, but they every so often, right, might have like a one-off thing of building a big unique software development platform that they hired out to contractors to do. And so, with timing, you might come across these people who just fairly recently made large sort of one-time or short period expenditures that do qualify. And so you can then, still capture significant credits for them. It just might be for a limited period rather than year over year able to claim those credits. But definitely important ones to keep in mind and keep on the lookout for.
So, John, I think to summarize at a very high level, basically any business that is creating or developing something that involves a technical uncertainty, so an uncertainty that is focused on hard science, that is a great first step to qualification toward the R&D tax credit, and certainly worthy of a discovery conversation between us and them. Right?
Yep, you got it. Exactly.
And the one other thing I'd like to point out is that these, whatever their endeavor is, or process, product, etc., does not have to result in success for those related activities to qualify toward the R&D tax credit. So it can be, this endeavor can be a complete failure, as far as, the finality of that effort. But those related activities can still potentially qualify as what are called qualified research expenses for the R&D credit.
Exactly. Thank you, Leslie Jo. And I'm glad you point that out, because if anything, those failed research projects are in some respect like even easier to qualify because there's that element around showing that there's technical challenges, technical uncertainties. The fact that the project failed and that you couldn't resolve those challenges is fantastic evidence that there was one. So very, very good point. And then, finally, I also want to say that a company, right, can one, claim the credit in their current tax year for which they need to file the taxes in, but you can go back and amend, right, for in general, federally, that's your last 3 tax years. You can go back to amend credits for, and so even with these companies that have either just not claimed the credit at all, or something like this banking example that I mentioned, where maybe it was 2 years ago that they made a big outlay on a software development project, they may still be able to go back and amend and capture those, and then enjoy potentially a significant tax refund that comes back in the form of a check for that. So that can be a really big impact. Okay, and so I just wanted to end with a couple of quick case studies here. This is, excuse me. This was one I worked on a few years ago. This was a California-based manufacturer, and these guys kind of designed and manufactured protective equipment of all kinds. That was safety equipment for use in construction. That was safety equipment for use in sporting and things like that, aviation, all kinds of applications. And so as a result, they did in fact have a pretty large employee count, but like many of the manufacturers, like I mentioned, a lot of those people were working the line for assembly, right, after sort of design activities occurred, and aren't eligible for inclusion. Even so, with a relatively small number of qualifying employees, I'd say it was about 20 to 25. And, from year to year, it might have been maybe 10 in 1 year and 20 to 25 in, the second year. But you combine that with a significant amount of supply expenses and testing expenses this isn't from that exact client, but I just wanted to show off this to make the point, they would design new helmets and they'd put them through these kinds of tests, right? Doing hydraulic presses, doing thermal protection testing, abrasion testing, you name it, right? And of course, that would then destroy the prototypes that they'd made. But the data that they got from that, they'd go back and refine it, make another iteration, and keep going. That ended up resulting in pretty, large expenses for these guys, and that resulted in just a 2-year period. They got a combined reduction to their federal taxes and to their California state taxes, which not every state, but a significant number of states have a correlating R&D tax program that's oftentimes very similarly kind of rooted to the same standards and rules and regulations of the federal. They might be directly tied, in fact. But yeah, just over those 2-year period, they had a net benefit to their tax liability of a reduction of around $140,000. It was pretty significant. Similarly, I thought this was a good kind of more recent example of one I've worked on where kind of the underlying primary activities of the company don't qualify, right? This was a wholesaler and kind of retail services type of industry. They had huge employee count, pretty large payroll, although most of that was administrative in nature, or again, fabrication and assembly that didn't qualify. And even the part I would think of as generally applying in a situation like this, because they were tied in with their manufacturing sort of arm of the goods that they were selling, that manufacturing section was all located overseas. And so we weren't able to include those. However, they did, recently hire a very, rather small in the grand scheme, but very highly compensated software team that was working on, making a very, significant and very sophisticated software platform that had a variety of, new and improved features that were also, external facing, right, for customers to utilize. And that combined with, a reasonable amount of contractor expenses that were supplementing this for, quality assurance testing, and things of that nature. They too found, enjoyed a tax credit of just federal alone that was in excess of $300,000, and that was over that entire sort of 4-year period that I mentioned, the kind of currently open tax year and the prior 3. And so those prior 3, because they were spending, they had already paid taxes in those years. They're going to be receiving like a very significant refund, and it was a very positive impact on their cash flow. So definitely wants to keep an eye out for. And with that, that completes my presentation for now. Do we have anyone else join during this that has any questions? I don't believe we did, so that's it. But, we like emails.
Well, I'll ask a couple questions. If that's all right. I'm kind of stuck on the process thing as far as developing new processes and maybe moving resources over. Let's say it's a manufacturing plant and, we're not getting new tools, but we find through experimentation that, we're doing things the wrong way and we re-engineer the process. And, let's say we're using the lean process or Six Sigma as our guiding, process. I'm going to say process 20 times. So if the resources that we lent towards that project and we, it turned out, we improved efficiency by 100%. I mean, is that something that would qualify?
Excellent question. I'm glad you brought this up. I'll very quickly get my lawyerly "it depends" answer out of the way, and then and then grapple with this more, which is to say that yes, it absolutely can qualify. It often does. The way you articulated it there in particular is the right way to be thinking about it, and I like that you said at the end about showing like what the result was, what the material sort of output was there, which sounded truly like an increased throughput, right? That sort of increase in efficiency is the sort that meets that kind of permitted purpose elements that I mentioned for a few slides back around what has to be improved.
Yeah, if I own a manufacturing company and I dedicated resources to our process, no new tools, nothing like that, just how can we re-engineer the process? Even if I failed, that might be qualifying?
Yes, even if you failed, that can be qualifying.
Just because I dedicated headcount to it, and the expenses for that were, I don't know, $300,000 or $400,000 over a 2-year period. It might qualify for some kind of credit.
Yeah, it absolutely can. And this is where, I both want to invite, sort of again, for people to be thinking in broader terms about what can qualify and how, lots of taxpayers do go overlooked, while still emphasizing some caution, because the devil here is in the details around substantiating those activities to sort of the IRS's satisfaction. This is, again, a frustrating part for me when it comes to how the IRS lays out things, where they lay out these incredibly sort of elaborate paragraphs that detail what the requirements are, but then there's almost literally like a 1-sentence piece that says what is sufficient to substantiate those. And it's phrasing more or less to the effect of taxpayers must, maintain sufficient records to substantiate. And it's like, okay, well, what does that mean, right? In practice, what I can tell you from experience is that the real problem here is around being able to accurately substantiate that amount of time that you're, employing, headcount and resources to these projects. And so that's, again, where we come in and provide. I think that's where a lot of the value that we provide really comes from. Is, when we're first engaged, we're oftentimes kind of coming in and we're doing more of like a forensic kind of investigation and potential sort of structuring and re-identifying this stuff based on the available data that they have at the time, the contemporaneous records, which are by far the most important. To an extent, what we're doing, the final reports that we're generating from that process, those are helpful and they are of material advantage to substantiating your credits. But if that's kind of like all you're providing without contemporaneous records, that's not going to fly, right? You have to be able to show kind of business records that were made kind of at or during or within a pretty immediate period after these projects in order to help substantiate that. The biggest element for that is around the wages, right? Because in theory, if you've got a fairly well-maintained and really sophisticated timekeeping processes in place, or if you have like project accounting data systems that you're utilizing that do a really good job of measuring individuals' time very accurately, both in terms of time period, but what those activities are, where they are, the nature of their activities, etc. Then you're not like foregone from claiming entirely, but you're then forced to kind of utilize the only other approach that we have, which is making reasonable estimates of those things. And case law does provide for this, and it's it goes back for not just the R&D credit, but taxes in general. That provided that you can establish the eligibility part on the qualitative standpoint, right? If I can show that the project itself meets those 4-part tests, which they're much more strict on, then when it comes to actually determining, okay, well, what expenses are associated with that, you are given some leeway to make reasonable estimates, but they need to be very conservative. And even those, it's ideal that you're utilizing a methodology for making those estimates that's more than 2 years later, somebody like me, having a conversation with you and you going, I think it's about 30% of the time. If you can do that though, then yes, you can absolutely qualify for processes. And that's where like somebody like a manufacturer, which I hate to say it, but sometimes these things are like an optics game, right? Where the IRS has a keen understanding of a general sort of manufacturing industry, taxpayer. They are much more predisposed to understand that they're going to engage in process developments that are aimed at improving throughput or, eliminating waste or eliminating defects, things like that. And they're more likely to qualify or find that the records that you've kept are, sufficient, as distinct from, I would say, especially like emerging kind of new industries. It might be more of an uphill battle, but yes, they can absolutely qualify. And I think that is of all of the categories, that's the most overlooked is process improvements.
All right, I have another question.
Yeah, please. Go ahead.
So I'm guessing that you two can qualify customers or clients a lot quicker than I can. And I'm just wondering about, is there like back in the beginning, you had the 4 steps.
Yes.
The 4-part test. So, I could ask if I have a client list of, a couple thousand, I could ask them, hey, have you guys done this? What's the best way to qualify customers to get to you all? I wouldn't want to throw over my entire 1,000 client list over to you all for you guys to figure it out. Is there an easier way? And does that
It's
make
the-
sense?
Yeah, it's the summary I mentioned. Basically, if they're developing something that involves technical uncertainty, it's really
Okay.
all you need to look for as far as then introducing them to us.
I could see all kinds of companies trying to justify that. Oh yeah, we have technical uncertainty all the time. So anyway, all right.
No, absolutely. And you do have to kind of take a read on clients in terms of how liberal or how conservative their approach is. I oftentimes encounter both pretty frequently where it's, somebody, what I would say though, to answer your question is that those top examples of industries I mentioned, manufacturing, software development, engineering, those are the kinds that, aside from maybe a very quick conversation that you have with them, that you have them just describe the nature of their work in their own words. If it sounds like it's meeting even just these first two elements, right? They're working on new improved products and processes, and they're having technical challenges. That alone is enough to say, get us in there and have an initial scoping call. Even if we have a 30-minute call and it doesn't bear fruit, that's totally fine. Sometimes we go to signing, and our first kind of 30 days of our process is meant to then get the books, do a greater analysis. And even then, sometimes, ones that seem like a good, eligible prospect turns out not to be. That's okay. We structure it to be risk-free to those clients, right? We're not going to charge them unless we've identified and, release credits to them. That's sufficient. Main thing is just to if it's something that is really off the beaten path, sometimes, if it's a restaurant that goes, all these new tools that they give the waitresses, right, that so that you can check out sort of right there at your table. They might think, oh, I implemented a new computer program through that. Those are the kinds that's like, unless you are really hearing something that's truly innovative and unusual, those are the ones to quickly bend.
Okay, and I think my last question is, let's say I have an engineering firm of 50 people, that 50 engineers work for me. 99% of my work or my company's work is on contracts for the government or Boeing or what have you, in which they're saying they're providing us the problem and, my team is solving for it and we get paid for it. That credit would not come to me. That would go to the supplier or the government or Boeing, correct?
Unfortunately, this is by far the one that is truly the most it depends. But my best way to answer your question is that if the way that you're being hired is more like I am required to provide, a specific kind of aircraft, let's say, and it has to, meet 50 specific specifications. That's go this fast, this high, et cetera. But you're really being tasked to create a product. And then the creation of that product requires that you have to then do R&D to resolve it. But whether or not the people that hire you pay you is contingent on you providing that thing. If that's the case, you actually might be eligible. Again, it's an incentive, right? That's trying to help you bear that cost of that risk of doing R&D. So in that case, you're kind of the one bearing the risk. Whereas, however, if it's more like more open-ended, right? I'm going to pay you $50 an hour for you to work on this no matter what, and I'm going to then pay you either way. That's more likely to go with that. And then lastly with that is do you get the rights in sort of that research results? It's actually two prongs. So if you're not getting to use the kind of the know-how that comes out of that work, you're probably not going to.
All right. Thank you.
Yeah, absolutely.